Hi, and welcome to my monthly Market Insights video. My name is Dan Timitich. I'm a managing principal and a portfolio manager at T2 Asset Management. Before we get started here, I just want to remind you this video is for educational purposes only. The opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, the overall stock market continues to soar on, and April gave us additional gains. But I would caution people when they look at arbitrary calendar dates to evaluate market performance. What I mean by that is if you take a look at the performance of the S&P 500 from October 1st of last year through April 30th, the market is up only about 1%. Yes, this has been a great year, but I wouldn't send out the all-clear signal just yet. We're simply back to the late September 2018 levels. Looking at sectors, we see pretty much a similar story. Financials did finally have a good month, but healthcare is continuing to struggle. I think a lot of this has to do with the rhetoric from Washington on price controls and Medicare for all, causing investors to be a little concerned about the regulatory future of the sector. But regardless, what sectors you favored this year, it appears that all of them made you some money. So how did we get here? Quite simply, this is basically a story about fear and greed. In 2018, we had a great run until about the end of September. At that point, the market started to worry about the Fed moving too fast. We had talks about trade wars, economic slowdowns, etc. The market basically went from euphoria to fear in no time. Once the Fed came out and said that they'd be patient, the greed kicked in and ricocheted the market much higher, pretty quickly, as a matter of fact. And if you've watched some of my past videos, you're going to remember me talking about the lack of a catalyst to propel us higher beyond the September-October highs. Well, we did temporarily make some new highs, but at the time of this recording, markets seem to have reversed and are headed a little bit lower. The point I'm trying to make here is that the markets go through these cycles just like everything else. I don't want any of my clients to get too caught up in the fear part or the greed part. Chasing returns is just as dangerous as selling when there's a lot of blood in the water. I've been cautioning investors all year to rebalance their risk and pay attention to some of the downside risk that's out there, but I'll be touching a little bit more on how I'm positioned later on in this video. By now, you've probably heard all the talk about stock buybacks and how they'll continue to support the market. Buybacks certainly have helped, but what really concerns me about it is the fact that corporate America has a history of buying stock back at very high levels. Here we have a chart from our friends at Yardeni Research that shows quarterly stock buybacks. And as this chart shows, buybacks peaked back in 2007, and we all know what happened in the following year. Look, companies, they tend to be pressured to buy back their own stock when they don't have other opportunities to invest their earnings. Do you really think that companies would buy back their stocks at these very high levels if they could find a profitable business or project to invest in? Of course not. And as this chart here shows, buybacks seem to have peaked right about the time that opportunities start to dry up toward the end of economic cycles. This here is just another chart from Yardeni Research that shows buybacks, but along with the S&P 500 index. And as you can see, when buybacks peaked back in 2007, the S&P 500 lost about 60% from peak to trough. Now, I'm not saying that this chart is any kind of claim that there's causality, but rather to point out that certain things that may give us an idea of where we may be in the market cycle, all the information that we gather can help us paint a better picture of where we are, not only in the economic cycle, but a market cycle as well. And I certainly don't want to imply that I expect to see the market fall 50 or 60%. But again, this is just a piece of information that could be helpful when we're analyzing things. Okay, getting to my four-part framework. These are the four major components that I look at when making investment decisions over both the short term as well as the long term. So let's take a look at each of these independently. As far as the economy is concerned, I consider us about neutral, not too hot, not too cold. We just saw a very strong first quarter GDP number, and inflation is under control. And with the unemployment rate falling to levels not seen in nearly 6 years, things are pretty good. So why isn't this positive? Well, I primarily think the first quarter numbers were a bit inflated. particularly because of the increase in inventories. And with the wage numbers increasing, that should put some pressure on economic output going forward. So I'm just basically looking at kind of like a neutral position in earnings, or in the economy. But turning to earnings, I'm generally neutral as well. I've said that in the past. I expect earnings to be positive in 2019, and with first quarter earnings season coming to a close, companies seem to be beating earnings estimates, but just remember that they're beating these lower estimates that analysts have been ratcheting down over the last several months. I've said before, I say it again, the price you pay does matter, and when you look at valuations, they continue to get more expensive, and the forward PE ratios are above their 5 and 10-year averages. Even if you take into account the low interest rate environment, you really can't say that stocks are cheap. Whenever valuations get a bit high, there is room for unexpected factors to knock them down, and at this point, everything must be perfect to see a significant move higher. That doesn't mean we can't bubble up from here, but I do think that there's more risk to the downside than there is to the upside. And finally, the markets are doing well. This recovery has started the year off pretty good, and we are starting to see the IPO market start to heat up. I am a little worried about the hype around the IPO market, and with the market pricing in perfection, investors need to be careful not to get too caught up chasing returns, and that's why I kind of have a neutral level here on the market. So where do we go from here? If you haven't done so yet, I would suggest that it's a good time to rebalance your risk. This run up in the market is giving you a great opportunity to get your risk back in line to your comfort level. Second, I'd lock in some of these gains. This is a great time to take these gains, increase your cash position, and be patient. I've already done this in my models. As an example, in my core equity model, I reduced equities by 20%. I hold about 60% in positions with downside protection and 20% in pure stock exposure. If we continue to bubble up, I may not capture all of it, but if we roll over, we'll be in much better shape. I am concerned, as I said earlier, about the hype around the IPOs and worried that investors will try to play catch up and chase. Uber is going to be the next monster IPO coming, and it looks like it may be valued as high as $90 to $100 billion. As it sits right now, Uber is losing almost $2 billion a year, and nobody knows if they'll ever turn a profit. We'll just have to wait and see if the market likes paying such a high price for a taxi company that's losing money every year. We'll see. I realize that most investors, they typically like to talk about the stock market, but the bond market is really what drives everything in the financial markets. Right now, the bond market is telling you quite a bit. It's telling you that the economic growth is expected to slow in the coming quarters, and that the Fed is officially out of the business of raising interest rates. Investors really need to be paying attention to what the bond market is telling you, and that'll give you a much better idea of what to expect, not only with regard to bonds, but with stocks as well. And finally, investors can maintain their stock exposure in line with their risk tolerance, but I do think that they should also hedge the risk to the downside. There's a number of ways to do this, and if you need more information on how we do it, just reach out to us. We're more than happy to help. Thank you all again for watching. I hope this video was helpful, and if you have any questions on anything in this video or just want more information on our investment models, don't hesitate to give me a call or send me an email. Thanks again for watching, and I'll see you next month.